And so I think vertical integration is great, but execution upon the vertical integration is more important than anything. Making sure we have the right management in place is more important than what type of management that is. Hello and welcome to Pillars of Wealth Creation, where we talk about creating financial success with a special focus on business and real estate. I'm your host, Todd Dexheimer. Now, let's get to it. Hey, welcome back to the show. I'm your host, Todd Dexheimer, and I hope you're doing well. I want to talk today a little bit about what it takes to be the best sponsor, to be the best owner, to be the best investor possible. So we're talking passive investing, active investing. What are the five habits for successful investors? And I actually was reading this on Bigger Pockets. So this was a post on Bigger Pockets, and I thought it was a pretty good post that discussed some of the things that are really key to becoming the best, most trusted sponsor, to becoming a limited partner that can find the best deals, to becoming a property owner that has a really good portfolio. So it kind of relates to everything. And I think these five components are really critical to being able to be successful. So let's start off with the very first one is clarity. And I think this one is crazy important. And really, I actually think it's, well, you know what? I think it's really, really important, but it depends on also where you are in your investing journey. And so if you're at the very beginning, and you are an active investor. So we'll break this down now. This is really, I think, more important. But if you're at the very, very beginning of your investing journey, clarity maybe is not that important. But when you actually start taking the action, having the steps to purchase. So if you are an LP and you don't have clarity and you passively invest in the wrong deals, those could be pretty critical errors. Same thing with an active investor. If you do the wrong things and invest in the wrong deals, those could be very critical mistakes. And your vision or your clarity will evolve over time, but I think it's super important to allow that to evolve in the beginning and try to nail it down as best you can before you actually start to take action. So I don't want it to hold you back completely from taking action, thinking you have to have the perfect vision, you have to have true clarity, you have to know everything that is important before you take action steps, because I actually think that leads to inaction. So I think that's really important that you don't freeze yourself, but it is important that you know what you're looking for. So your investing goals, right? You know that what do you want? Like, do you want cash flow or do you want equity, right? Equity growth. Do you have a short timeline? Like, do you want your money back in 6 months or a year? Do you want your money back in 3 to 5 years? Or are you like, hey, look, I just want some awesome cash flow. This is a long-term investment. And I know when I get my money back, I got to pay taxes. So I'm not super excited to get my money back. If I get my money back, I want to be through like a refinance or because we're making so much dang money on this deal. Like, you have to understand which one is for you. Are you good with illiquidity or do you need liquidity? Right? What is your risk tolerance? Are you okay with taking some big swings at deals that maybe could end up blowing up? Or are you like, hey, look, I want to protect my capital. That might mean a little bit less returns. That might mean a little bit slower growth, but man, I really want to protect my capital. That's really important on all sides of the aisle, whether you're a passive investor, active investor, it really doesn't matter. You have to understand your vision. You have to understand, like, again, like, is cash flow important? Cash flow in properties for me, why I like it, why it's important for me is because it keeps the lights on. It keeps that building running. I know if I've got good, strong cash flow, I'm not just talking a little bit of cash flow or cash flow on paper. I'm talking good, strong cash flow. I know that that property can withstand some pretty good ups and downs. I know we already have a base case, right? If I buy that property today and it cash flows, I already have a base. And that base says, look, this property is pretty decent. I know where it can be. I know where especially if it's a value add, like I know where an okay operator can run it at. So if I can do better, we can grow that. We can create the equity, but we've got the cash flow today. That to me is really attractive. Now, other people might say, look, I don't care about the cash flow. I want a property that I can build a ton of equity in. And I don't care about the cash flow. I don't need that. And I'm okay with taking that risk, which is that's what you're doing. If you don't have the cash flow, you're taking a bigger risk. I'm okay with taking that risk for a bigger reward in the end. I'm okay with, you talk about risk tolerance, like, look, you've got different debt structures, right? No debt is the lowest amount of risk. If I got no debt on the property, and I'm buying a cash flowing property, I've got very little risk of things going south. I just don't have much there. We got big margins, probably 50% margins. The debt is just not obviously going to hold us back because we don't have it. But if we're going to go and put, fixed debt, that's maybe 50 to 70% loan to value. Obviously, more loan to value, the more risk, but we also got to consider the debt service coverage, right? How much are we actually in there with the margin, right? How much margin do we have? Do we have 50% margin on our profit? Do we have 25%, 30%, 75%, 100%? Like what kind of margin do we have? Well, not 100%, but what kind of margin do we have? And that's really important to understand the risk, right? And so fixed debt is going to be definitely your least risky with high DSCR and low LTV. Those are very small risk tolerance. We play in that kind of field. We don't like a lot of risk. We have played in the next one that I'll talk about, which is the highest amount of risk. We have played in that higher risk field. And we've learned lessons along the way, and we've realized why we never really loved that side of the aisle and why we just don't really want to do it again. And not saying we would never do it again, but saying that our risk appetite is just not quite there. And if we're going to go the riskier route, we're going to do things that really provide a cushion to the risk, right? And so the riskier side of the coin is that you're going to do floating rate debt. You're going to do high leverage debt. So you're putting debt on not only the purchase price, but the renovation price, right? You've got low DSCR. A lot of groups or investors are buying properties with below 1.0 DSCR or close to 1.0, meaning that the net income, right, doesn't pay for the mortgage or barely pays for the mortgage, right? You're just breaking even. You're not cash flowing. And so that's higher risk. So think bridge debt. Bridge debt is the highest risk that you can put out there, right? And that, it's, by the way, it's okay if that's your risk tolerance. You're likely going to end up going through some trouble, some turbulent times if you have bridge debt, but you'll also go through some really good times. So look, I mean, any investor that bought properties and sold them by, call it 2022, and bought prior to that, with bridge debt, did really, really well. They just did. They did great. They looked like geniuses. And so they've got a great track record with the bridge debt. But anybody who bought in, prior to 2022, yet is still holding onto that property today, or maybe has either lost the property or sold the property, doesn't look like a genius. Looks like they've done things wrong. And so that's the risk with bridge debt, is you will get caught in market cycles. Now, there's also higher risks with that floating rate bridge debt. We can put mezz debt on it, pref debt on top of that. And these are just layers. We can stack layers upon our debt and even get it more to where we've got, a pref equity. This is technically an equity partner, but they're more of a shark type partner. And they're going to take a lot of profit, and they're going to take profit before you get it and before your investors get it. Now, if you're a limited investor, limited partner, and there's pref on it, you're behind that pref. So you have to understand that, or mezz, or whatever it is. So where are you lining up in the capital stack? The least risky is to be right underneath. Well, the least risky is to have no debt, right? Again, but the next least risky is to be right underneath the senior debt. And the best senior debt, as far as risk or low risk, is the fixed rate. And the longer the term of the fixed, the less risky, right? And then you've got the floating rate that's definitely much, much greater risk, but it's still less risky than if we then layer on a pref or a mezz or something like that to that. Think of it basically as a second mortgage. Now you got your first mortgage. Now you've got your second mortgage. Now you're next in line. And you could even have that. You could have first, you could have a second, you could have a pref, and you could be next in line. And the farther on down you're on the line, right? It means you have less crumbs to eat from the table, and you've got more risk exposure. So you got to really determine that. I've belabored on the risk. I want to make sure I get to all of these, so I don't want to be here forever. The timeline, it's really important, in my opinion, to understand how long you want to be in investments. And I think that's super important, because some groups are more tolerant to longer timelines, and others are just desire short timelines. And again, there's no right or wrong answer. Look, if you are a passive investor, you want to be a passive investor, and you want to get in and out of these properties really quickly, well, then you should think about being more like a hard money lender, right? You should think about being, how do I get into people that are flipping homes and doing things where I can get my money to them, and I want my money back in 6 to 12 months, right? I want it to be quick, right? I want more liquidity in it. If you're like, hey, maybe, you know what, I'm okay with a little bit longer timeline, but I don't want the forever timeline. Well, then, okay, let's look at syndications that are 3 to 5 years. And again, if you're the owner, and you could flip properties, you can wholesale properties. If you're okay with a little bit longer timeline, you can do that, 2 to 5 year timeline, and decide. You just have to look at the implications, right? And same thing with the very, very long term. Like, we love longer term, but we also don't mind kind of middle term as well. So when I talk middle term, I'm talking that 3 to 5 years, maybe 6, maybe 7, but and then when I'm talking long term, I'm talking, 10 years, maybe plus. We like both of those. I really love the 10-year plus. But you got to decide what's best for you. Again, like, do you need the liquidity? Do you care about the risk? The higher risk is going to be the shorter the timeline, right? That's going to provide higher risk. It's just the execution has to happen before a market cycle happens. And if we've got long term, Well, as long as we got long term and we set ourselves up for long term. So that's the other thing about clarity is if I know my plan, I can actually plan around it. So I would not go out and buy a property if I want to hold the property for 10 years. I would not go out and buy that property and put on, floating rate debt with mez on top of it. That would be crazy. That's setting myself up for failure. The only way to be successful on that is to sell it, right? That's it. So if I got a long-term vision, that's just not going to work. I have to make sure I align my vision with everything on how I'm executing, right? And so I need to make sure those are both aligned. So clarity is really important there. Um, and then, look, I think just having the clarity allows me to understand so much about where I want to bring this company in the future and how I want this to grow. The other thing too is I haven't talked about is clarity is super important, or your vision is really important. So you can buy the right asset, right class. You can really focus on the right deals. I think you're more successful if you've nailed down not only the market or markets you're investing in, the class of property you're investing in, the type of property you're investing in, all those things. And the more you can nail those down, the better. What kind of property are we actually looking for? And not bouncing around the board. Now, with that said, I'm okay with there being some variety to it, right? If you find a great deal and it doesn't quite fit your vision, but it is close enough, I mean, certainly, but that's probably not what you were looking for. It just happened to come to you because you had the clarity, you had the vision, other people trusted you, you have the reputation to close on assets, all that kind of stuff. And now this property kind of falls into your lap and you say, hey, is this close enough to what I'm looking for? Yes or no? Does it check enough of the boxes? Sure, let's move forward, right? All right, let's move on to the next one. And this next one is really important. And I think really when we look at being successful, I say that those who have you're going to be successful if you have a good management team. If you have a good management, if you have a good management team, if you have the processes and the systems in place. So do whatever you can at the beginning before you start. If you're going to be an active investor, before you start, you need to make sure you have all those things, all those ducks in a row. And that might be hiring the right third-party groups, right? But you got to make sure you have the right management and team in place. You have the right processes and systems in place to be successful. The right technology, not just technology for technology's sake, not just education for education's sake, but the right things in place to be successful. So I think it's super important that those pieces are actually in place and we understand how they fit together. And so if you're a passive investor, look, I mean, what is this company, doing, and how are they going to actually be successful to execute the business plan? I think that's maybe one of the more underappreciated things when passive investors are looking at executional risk and saying, oh, the management team's in place or is it not in place? They just don't look at that. And so I think if a group has, in-house management, that's great, but does that in-house management have the experience? Do they have a good reputation? Do they have clarity and vision within the management company? Do they have good leadership in that management company? So just because you're a passive investor and this group you're investing with has its own in-house management does not mean it's a good thing, by the way. A lot of people will say, well, we're vertically integrated. Vertical integration matters only if it's executed upon properly, right? If you have vertical integration and you suck at what you do, that doesn't mean it's a good thing, right? I would rather you use third party property management. I would rather have you see you use, uh, a general contractor and do use people outside of your firm if you aren't good at those key items. And I think it's so funny people tout being vertically integrated without any explanation of why that's a good thing. And again, I I'm all for vertical integration. We are vertically integrating ourselves. We have a lot of properties we're managing in house. We're managing a lot of construction in house. And so I think vertical integration is great, but execution upon the vertical integration is more important than anything. Making sure we have the right management in place is more important than what type of management that is. So just make sure that you are thinking through that process as you're setting up your team, as you're setting up your systems, as you're executing. Make sure that you have a that really thought through and the right people in place to be able to make sure that you can be successful from the beginning. Again, I would rather you use third party. I know a lot of people that are very successful, that have done very well, that have been in business for a very long time, that use third party property management, or who have started using third party property management and then slowly transitioned over to in-house property management. Either way, I know a lot of people who have done both of those and have done really, really well. And so I don't want to tell you that there's one size fits all. Certainly, great execution is more important than the the type of management that you choose, right? Third party or in-house vertical integration. Um, when we talk about management, I think the most important part, and I've already mentioned this, is the execution. The execution is huge, and so you execute on what you're setting out to do. Do you have the right leadership? Do you have the right vision? Do you have the right business plan in place? The business plan goes back to the clarity. And didn't really talk about that, but we want to have a business plan for every single asset we buy, not only for the entire company and portfolio, but for every asset that we buy. We want to have its own unique business plan. And so when we're talking about the management, do we have the right team that can execute on that business plan to be successful, to make sure that the property is actually running the right way? The next one is reputation. Look, LPs, you have to be able to trust whoever you're going to invest with. So if you are going to invest, make sure that that group has a good reputation. And just because they've done a bunch of deals and those deals have been successful, it doesn't mean that their deals they're doing now are going to be successful. Just because they've done deals and some of them have not been successful doesn't mean the deals they're doing now won't be successful. So you've got to, I think a track record is important to look at. And I think it's great to see a company that executed and did well, but don't, but you also need to look beyond that, I think is what I'm trying to say. A group that bought in, 2018, 2019, 2020 and sold those assets before, really before 2023, the clock turned 2023, they should be successful. Like those should be profitable. If they're not, then you definitely have probably major questions to be asking. But those should be very profitable properties. Um, that's just expected. Like to me, that did not prove a reputation of execution. I would want to dig much deeper into that. What are their deals doing now that they've bought since then? How have they pivoted? If they've had any deals that aren't working as good currently? How have they pivoted in this market and the cycle change? What are they doing differently? Are they doing everything the same? Because if they're just doing everything the same, they're going to get this probably the same results, right? And so if they have properties that have struggled and they're but they haven't changed anything they're doing, well, don't expect something different, right? The only thing that works in their favor is the market. So if the market's working against them, things are going to go bad. If the market's working for them, things are going to go good. Great. Is that what you really want to, want to put your money into? How are they executing properly for today's market, for every market, and changing strategy or pivoting the right way? And so I think that's really important. The reputation upon as you talk to other investors, as you talk to brokers, as you talk to anybody that has dealt with them, like what is their reputation? Do people who deal with them trust them? Do they like them? Do they think that they're good people? Do they think that they're honest? How are they communicating with you on a monthly basis, daily basis, whatever? How do they react to problems? How do they react to issues? How do they react when somebody puts some pressure on them? Are they just, if somebody talks bad about them, not that I expect them to bend over and to just take whatever is thrown at them, but how do they react in those types of situations? I could think of some sponsors that their reaction to me tells me that their character is very flawed, and others that their reaction tells me that they've got really high integrity and character. So I think that's super important as well. I mean, through this period of time, I have been watching sponsors, and there are sponsors that I will put my money with, and there are other sponsors that I won't. And the ones that I'll put my money with, some of them have lost money during this time for their investors. They've lost their investors' money. And some of the ones that I would never invest with, as I've watched, have also lost their investors' money in it, or are on the the verge of losing their investors' money. But some haven't, right? And so I think it's really important to kind of watch these sponsors and understand what's going on. Okay, that's on the passive side. On the active side, look, I think your reputation is key to your success. This is probably the first one I should have talked about, is the reputation, because reputation matters probably more than really most things. I want to have a great reputation with the brokers. We have a reputation in the market of definitely coming in low. Like we have a reputation that, and not low balling. Like we have a reputation that we're very conservative, that we're not going to pay top dollar for properties. So a broker is not going to come to us with a deal knowing that we're just going to get this thing closed because we'll buy anything for any price. So they're not coming to us for that. So that is our reputation. We're okay with it, by the way, because properties have to work for us, and other people can make a deal work that to us looks bad. Like it is what it is. Like we look at that deal and we go, man, that's a terrible deal. That price is crazy high. We just can't pay it. And somebody else looks at that deal and goes, wow, what a great deal. I'm going to buy it. Right. And they're going to raise their capital for it. And that's great. But that's not us. And so brokers know that. But brokers also know that we will execute. We can execute. And if we put a deal under contract, we will get it closed. And so brokers know our reputation is deal maker, right? We will get this deal done no matter what. And so most of the deals, I don't know if there's any deal that we have bought that has not came back on the market and came to us then later. Several of the deals have been under contract two or three different times with different groups. And they fall through, and they fall through, and they fall through, and they come to us and say, I know you guys aren't quite at that price. What can you get to? And we say, we can get here. And they go, okay, let's go. Right. That's how we've bought almost every deal. So reputation really matters. Reputation to me, look, same thing with our investors. We want a good, strong reputation. Every reputation tells you about your character. And so, if you get the right reputation in the market, you're going to, do a lot more business. And to me, you're going to enjoy life a lot more if you've got a good reputation. If people know that you've got integrity and that kind of thing. Same thing with management too, and residents. Like, look, I mean, residents will spread the word, right? If you're doing good, they're going to tell their friends, they're going to tell their family. Like, word gets out that this is a great property, great management company. People running are really good. They take care of us. Word gets out. So reputation is really important. When we're looking at front facing, reputation is important. When we're looking at investors, when we're looking at getting deals, lenders, and so on. City knows the locations that are good, that actually take care of their property. They're going to leave you alone a lot more than if you've got this bad reputation. So reputation, and making sure that the people you're surrounding yourself with also have that good reputation, and then the integrity that you really feel is important to you. And so, look, I almost did a deal with a couple guys, and one of them had. I found out as I got into it further, one of them had a kind of a bad reputation, and to me, it just wasn't worth it. And because I knew that if I did deal with this guy, and things went, even if things went right, but if things went wrong, especially, like, my reputation would match his. But even if things went right, people would start to associate me with this guy who already had a bad reputation. I didn't want that. So I ended up starting this relationship, going down that road, and then realized and found out more about him, which, this is my next point that I'm going to talk about. But found out that he wasn't the best guy, at least had the best reputation. So I said, thanks, but no thanks. And so that's my next point, is due diligence. Due diligence is number, what am I on? Number 4. Due diligence is number 4. Look, you have to make sure you're informed. You don't just jump into every deal. Also, that you don't jump out of every deal too. But you need to have transparency. You need to know what is happening in every deal. So due diligence is really important. And so when we talk on the passive investor side, look, I think it's so important to really understand not only the sponsor and their reputation, and how they execute, but it's also super important. And this one, I feel like it just gets kind of, people talk so much about the sponsor and their reputation. I think that, again, I don't want to say that's not important, because it is, but I think what's really missed with a passive investor is that you need to be doing due diligence on the actual asset, the city, the management team, and on the business plan. And you need to understand if this is a strong business plan. Like, don't just bet on the sponsor because, whatever, like, does this actually fit your vision, your goals? I already talked about it. Like, look, if you want cash flow and low risk, then why are you investing with that sponsor that is doing, floating rate bridge debt? Oh, they got a rate cap. Come on. Like, why are you investing with that sponsor that's floating rate, bridge debt, short term? Like, it doesn't make sense. Like, I don't get what, because they show really good returns. Well, is that your vision? Like, what's your vision? Now, if that is your vision, then you should invest with that person. If your vision is, hey, I'm good with taking a little bit more risk. I like the risk. Um, I like the short-term deals. I like that I'm okay that they don't cash flow very well and that they're creating a ton of equity and that pretty much all the profits coming at the sale. That's fine. Then go invest in that deal. But understand and do your due diligence so you know what you're getting yourself into. I was on Bigger Pockets the other day, and this person's talking and it's like, I would never invest in this deal if I would have known about, if I would have known they're using floating rate debt, and if I would have known that they weren't going to cash flow in the first 3 years, and I would have known if this and this. And I'm like, so you're telling me you're an idiot and you didn't do your due diligence. And so you want me to feel bad that you're in this deal that's doing really, really poorly, but yet you didn't do your due diligence. You didn't know the risks, and you didn't have any clarity of what you were wanting to invest in at the time. And you likely just chased a return, or in this case, they went with a sponsor who, had a good reputation, quote unquote, good reputation. And so they just went with that sponsor because they thought that would be the best thing to do. They did no due diligence. So do your due diligence. And as an owner, the same thing. Like, you need to understand what's going on with that asset. You need to really, truly dig into that asset, not only into the physical part of the asset, but in what's happening economically with that asset. What are the residents like? What is everything like with that asset? And is it the right asset for you? Same thing with your management team, same thing with your partners, all that kind of stuff. Make sure you're really digging in and doing due diligence and getting the right people in place to execute on the plan. The very last thing is diversification. I think it's super important. This one is probably, well, it's important for both, but diversification, especially for the passive investors. Look, I think it's super important to spread your capital along multiple sponsors, multiple markets, multiple deal types, so you can reduce risk, right? It's really important that you move money to different spots to reduce risk. And even within that sponsor, if you're going to invest in a sponsor over and over and over again, trying to invest in different deal types is really valuable if they offer that. But I think that's really important, is that you diversify. You don't just trap yourself into one deal, because, if that deal goes great, you're going to be jumping for joy. But if that deal doesn't, you're, obviously the opposite. So, and then I think it's really important for, those who are raising capital, that you get investors from outside of just your friends and family network, that you build a good base of investors, that you continue to grow that. So diversify that. And then look, even as an owner, I think it's really important. And I want you to have clarity, but I think it's really important that you have a little bit of diversity sprinkled into your rental portfolio. No, what I'm not telling you to do is to go out there and buy a single family home, and then an apartment complex, and then go buy a mobile home park, and then go buy some land, and then go buy an Airbnb, and then go, like that. Like that is not the diversification I'm talking about. But I think it is important that, we are in several markets, and I think that's super valuable. We're executing on very similar deals, but even throughout that, like, we do have different types of deals in our portfolio. We have townhome deals. We have regular, just, the traditional apartment deals. And quite frankly, we do have some good diversification. We have a retail strip center. We have some assisted living. We have We have an industrial building. So we do have some diversification, but I think more importantly is that you have a little bit of diversification within your portfolio, not spreading yourself too thin. I want to be careful that you don't do that, but um, I think it's important to not have everything be the same. What I think what gets people into trouble is they buy a ton of single family homes and they're buying them one by one and they're all in the exact same neighborhood. I would rather have you buy a ton of single family homes, but have, a dozen of them in one neighborhood, a dozen of them in another neighborhood, and a dozen of them in a different neighborhood. I think that's the diversification that you would want. I think it's also valuable if you're buying 3 bedroom, 2 bath homes. You also buy some 4 bedroom, 2 bath homes, some, just some variation there. So, all right, that's all I got for today. Those are the habits for success. So we talked about clarity. We're talking about management and execution of management. We talked about reputation. We talked about diversification, and we talked about due diligence. All right, you have a fantastic rest of the day. Make every day Saturday. Hey, thanks so much for listening. I appreciate you being a loyal listener. I would love to have you go on to our Facebook page and subscribe, give us a thumbs up, go on to iTunes or wherever you listen and give us a rating and review. Don't forget to subscribe. Your rating and review just helps us push this out to more and more people and continue to grow our audience and hopefully positively affect a ton of people out there that really need this and want this. So the other thing I've got for you is a free ebook on my website. So go on to venturedproperties.com, and download our free ebook on real estate and on syndication. And I've got some data points in there, some really good stuff for you. So I'd love to have you take a look at that. It's free. I'm not expecting anything from it. And also, look, if you want some help in multifamily, want some help learning, growing, getting your business off the ground, I would love to talk to you about what it would look like to work with me potentially and see if that's a good fit. So you can go to coachwithdex.com and check that out. And we can definitely have a call. Thanks a lot for listening. You make it a fantastic rest of the day. I'll catch you on the next episode.